Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
Hey Lauren, I had a client write in with an article, and I really appreciate our clients contributing ideas for these topics. And the article is titled, "With an Annuity You're Buying Peace of Mind and Predictability."
Okay.
All right. And then just by coincidence, I was opening up USA Today, and this is called "The Allure of Annuities, Automated Income." Okay. And so, first of all, this is not going to be a whole discussion of every type of annuity and variation, but just to read real quick, there's basically two types of annuities. There's a fixed annuity, which people make a deposit of their assets, and for that they give up their right to that asset, and they're going to get lifetime income for the rest of their life. That's a fixed annuity. And then there's a variable annuity, which kind of has the similar feeling of investing like in mutual funds.
Right.
You get market rate growth, and these variable annuities, your payout is predicted about what your return is on the investments. How they're sold is that until you take the money out, the growth is tax deferred, and then they also are now putting in these things called like living guaranteed income benefits. So for instance, if the market goes down, you can still take out 5 or 6% of your annuity per year. So those are the main two core characterizations of them. The one thing I was just going to say is now, first of all, do you have any initial opinion of annuities? Because I have a couple examples in here that bother me a little bit.
The immediate annuities, just the basic ones where you give the insurance company your money and you get a payout for the rest of your life, those are simple, and you either want them or you don't.
Right.
There's not much discussion there.
Right. So they use an example here for that one. I'll talk about that for a second. So a female age 72, they invest $100,000, and this is they're going to get a lifetime benefit of $7,265. And so the way that works is basically if you live about 13 years, you'll break even.
Right.
And then if you live above that, you'll start making growth on it.
Yeah, that's still a low rate.
Yeah.
The thing about even those annuities, which people who bought them in 1999 are really happy. Those annuities, the rate that you get, the amount of money you get per year is based on your age, and it's based on what interest rates are,
which are very low right now.
Which are very low right now.
The thing that bothers me about this article is that they use this senior VP of Penn Mutual Life Insurance saying, "Annuities are a great vehicle. We have this one client that bought an annuity in the 1980s. She's still collecting. She put in about $100,000, and we paid her more than $800,000 since." The disingenuous part about that is that's when interest rates were a lot higher.
Yeah, exactly. Well, when interest rates were 12% or whatever they were, I don't know how much they were at the time that annuity was sold, but they were very high. Things were quite different. Yeah.
So for the math to work on current annuity rates, to get that same amount of payout, the person had to live 100 years. So not a fair fight.
No.
Okay. So okay.
Although if you are going to live to be 170. An annuity is a great deal for you.
Exactly. The longer you live, then you're getting more of a payback. Just be clear, when you invest in an annuity, you're giving up the right to that asset on that. Now, the variable annuity, they use an example in here. If you look, it's pretty clear that there are downsides to it, because they're typically, especially if you're using the typical annuity is sold on commission, so most of them have a surrender charge to get out of them.
That's right.
And they predict their analysis Morningstar says that annuities using mutual funds inside of them average about a 3 to 4% cost per year. That's their annual cost. So you have to have this so-called living benefit guarantee. You're paying a lot of your growth in investment fees. What do you think about that?
It's not going to work out.
Yeah.
It just isn't.
It's not, I mean, mathematically, it makes it sound good initially that you're going to get some insurance company guarantees, but you're paying a lot of cost for that guarantee.
And those guarantees are never quite what they look like on the surface.
Right. And then last but not least, and this is where Lauren and I come in from a tax perspective, if you had your money in a structured low-cost index mutual fund invested, or compare that to investing in a tax-deferred annuity with a 3 or 4% expense ratio, not only are you paying a higher expense ratio, but the taxation is a lot worse, because immediately the first time you put that money in an annuity, all the income that comes out of it is called ordinary income.
That's right.
And so that your tax bracket could be anywhere from 30 to 39% versus a long-term capital gain in the way we like to invest might be 15 to 17%.
Right.
So anyway, there's this guy named Ken Fisher that talks about annuities in almost every daily newspaper. I just want people to be aware that annuities is a huge buzzword. Unfortunately, billions, I think like $80 billion of annuities were sold last year.
Yeah,
they're still really popular.
That's right.
All right. So if you are contemplating an annuity, or you're in an annuity that you're not sure if it's a good one, please use Lauren and I as a research, and we'll help you evaluate if that's the best decision for you.
That's right.
Thank you for watching this episode of EricksonTV. We'll see you next time.
See you next time.